5 seconds of silence. Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome. Every single business, from the corner coffee shop to a massive global corporation, has a story to tell. And that story is told through its numbers. In this explainer, we're going to deconstruct the system that writes that story, the accounting information system. We'll take a professional, step-by-step look at exactly how financial activities get captured and recorded. So, here's our roadmap. We're going to move through 5 key stages, starting with the absolute foundation, the basic accounting equation. And then we'll build our way up, piece by piece, to a complete recording system. All right, let's get started. Okay, section 1. We have to start with the absolute bedrock of all accounting. We're talking about the system that captures a company's financial data and the fundamental equation that ensures everything, and I mean everything, stays in perfect balance. So at its heart, the system is all governed by this one elegant formula: assets equal liabilities plus shareholders' equity. Now, the crucial point here, and you really need to grasp this, is that the system only records what we call accounting transactions. These are specific economic events that cause a measurable change in a company's assets, liabilities, or equity. For instance, hiring a brilliant new CEO is a huge event for a company, right? But it's not an accounting transaction because at that moment, no money has changed hands. Nothing on the financial side has actually shifted yet. All right, let's put this theory into practice. We're going to walk through a whole series of transactions for a hypothetical company we'll call Big Corporation. Our goal here is to see how that core equation, assets equals liabilities plus shareholders' equity, always stays in balance. You'll see how every single recordable event affects at least 2 parts of this equation. Okay, first up, Big Corporation issues $120,000 of its shares for cash. So what happens? Well, on the left side, its assets, specifically cash, go up by $120,000. And on the right side, its shareholders' equity, in the form of common shares, goes up by the exact same amount. See that? Perfectly balanced. Here's another example. The company borrows $500,000 to buy some new equipment. So the asset side increases because they now have the equipment. And the other side of the equation also increases because now they have a liability, that bank loan payable. Again, the equation holds true. Now, what about everyday expenses, like rent? Well, paying rent decreases the asset cash, but what's the other side of the entry? It decreases shareholders' equity. Why? Because expenses reduce the company's accumulated profits, which we call retained earnings. This next one is a bit different, but really important. The company pays for an entire year of insurance up front. Now, notice what's happening here. It's just an asset swap. They're trading one asset, cash, for another asset, prepaid insurance. The total value of assets hasn't changed at all, so the right side of the equation is completely unaffected. The classic on-account purchase. This phrase just means the company got the goods now, but will pay for them later. So their asset, supplies, goes up. But so does a liability called accounts payable. It's basically an IOU the company has to pay. And of course, this works the other way around. When the company makes a big sale on account, they haven't gotten the cash yet, but they have earned the revenue. So they gain a new asset, accounts receivable, and they increase their shareholders' equity through that sales revenue. Now, this is an interesting one. A client pays them $10,000 before the service is provided. So yeah, the asset cash goes up, but the company hasn't earned that money yet. That means they now have a liability called deferred revenue. It's an obligation to provide that service in the future. Okay, time to pay off some of that debt. The company makes a payment on its accounts payable. So what happens? The asset cash goes down, and the liability accounts payable also goes down. Both sides of the equation shrink together, keeping everything in balance. Paying salaries should feel familiar by now. It works just like paying the rent. It's a salaries expense. So cash goes down, and shareholders' equity takes a hit because expenses reduce those retained earnings. Now hold on. A dividend is not an expense. This is key. It isn't a cost of doing business. It's a distribution of profits back to the owners. So while it does reduce the company's cash, it also directly reduces its retained earnings. Remember that big sale on account from earlier? Well, the customer just paid up. So what's happening here is another asset swap. The accounts receivable asset is converted into the cash asset. The company's total assets, they haven't changed one bit. And finally, paying taxes. Just like rent and salaries, this is an expense. It reduces both an asset, cash, and the shareholder's equity. So as you've seen through all 13 of these transactions, no matter what happens, that fundamental equation always holds true. So using pluses and minuses works fine to understand the concept, but can you imagine a company like Apple trying to do that for millions of transactions? No way. To handle this at scale, accountants developed a universal language, the system of debits and credits. Okay, this table simplifies everything. First, I want you to forget any other definition you've ever heard. In accounting, debit simply means left, and credit simply means right. That's it. Think about the accounting equation. Assets are on the left. Therefore, they increase with a debit, a left side entry. Liabilities and shareholders' equity are on the right, so they increase with a credit, a right side entry. But what about expenses and dividends? Well, what do? They decrease shareholders' equity, which is a right side account. So to make a right side account go down, you need to use the opposite, a left side entry, a debit. That's the core logic that makes the entire system work. All right, now that we have the language of debits and credits down, let's look at the official process that accountants use to formally record every single transaction. This process really follows 4 systematic steps. First, we analyze the transaction to figure out what's affected. Second, we journalize it. This means we create a debit and credit entry in the company's journal, which is basically a chronological diary of all its financial events. Third, we post that information from the journal to the general ledger, which is the master collection of all the individual accounts. And finally, after all that's done, we prepare a trial balance. Which brings us to our final section. After all that analyzing, journalizing, and posting, there's a critical question we have to ask. How do we do a quick check to make sure we didn't mess anything up along the way? That check is called the trial balance. It's an internal report that simply lists every account and its final balance. Its main purpose is to prove one simple thing. Do our total debits equal our total credits? But, and this is a critical limitation to understand, it is not a foolproof guarantee of accuracy. For example, a trial balance will still balance perfectly if a transaction was missed entirely, or if a correct entry was posted twice, or if the wrong accounts were used. It's a check on the math, not a check on the logic. And that is precisely why a thorough understanding of this whole process is so essential. And that brings us to our final thought. In an age of sophisticated software that automates this entire process, why does learning these manual steps still matter? Because understanding these mechanics, the debits, the credits, the journals, is what allows a professional to diagnose errors, to design effective systems, and to truly interpret the story that the numbers are telling. It's the difference between being a data entry clerk and being a true financial professional who fundamentally understands the language of business.